So this is the difficulty people have with different time horizons. So interest rates are set by the Federal Reserve. The Federal Reserve operates in core inflation land, which is driven by core inflation and unemployment, which is driven by stuff like owner equivalent rents and stuff. All of this stuff is lagged. So the Fed operate in that lags. Stuff like crypto and tech stocks are trading on liquidity and future liquidity. So financial conditions, they eased a long time ago. So people looking at the Fed saying, well, when the Fed raise or when the Fed cut, that's not relevant. What's actually relevant is what the kind of financial conditions are doing, which have been loosening massively, and liquidity has been rising. Whether you use Fed net liquidity or broader measures or M2, they're all rising on a global basis. And the global basis is another key thing most people miss because they kind of look at the US only. But, you know, if we look at this cycle, who's got the biggest economic problems right now is China. So they probably have the biggest bazooka to fire to try and get their economy going. Then it's probably the Europeans, then the US. You know, it feels that way.
Raoul Pals touches upon a complex and nuanced understanding of financial markets, especially highlighting the mismatch between the time horizons that different market participants focus on. Let me break it down for you. Federal Reserve's role and decision-making. The Federal Reserve, Fed, is the central banking system of the United States, and it plays a crucial role in setting interest rates. Powell points out that the Fed's decisions are heavily influenced by core inflation and unemployment rates. Core inflation excludes volatile items like food and energy prices and can be driven by factors such as owner-equivalent rents. The Fed uses these indicators to gauge the health of the economy and to make monetary policy decisions. However, there is an inherent lag in the impact of these indicators and the Fed's actions based on them. In other words, by the time the Fed reacts, the economic conditions might have already shifted. The immediate response of markets. In contrast to the Fed's longer-term perspective, markets such as cryptocurrencies and technology stocks respond more immediately to changes in liquidity and future expectations of liquidity. Financial conditions and liquidity can loosen well before the Fed makes a move, influencing these markets. Essentially, while the Fed might be looking at past and present economic indicators to make decisions, these markets are trading on the anticipation of future financial conditions. The importance of global perspectives. Powell emphasizes the significance of taking a global view when analyzing financial markets. Often, there's a tendency to focus solely on the US, however, understanding global liquidity and economic conditions is crucial. For example, at the time of his speech, China faces significant economic challenges, positioning it as a key player likely to implement substantial measures, the biggest bazooka, to stimulate its economy. Following China, Europe, and then the US are also key players to watch in this global economic cycle. In essence, Powell is drawing attention to the need for investors and observers to consider a wider array of factors than just the immediate actions of the US Federal Reserve. The dynamics of global liquidity, the anticipatory nature of certain markets, and the interconnectedness of global economies are all critical components for a deeper understanding of financial markets. This broader perspective helps in navigating the complex landscape of global finance, beyond the traditional metrics and timelines that are often the focus of central banks.
We've seen liquidity. You know, I managed to catch the bottom in crypto and tech last year because of liquidity had bottomed. And the moment it bottomed, ETH bottomed first, and then the whole space bottomed, including tech, in October. And it's just been following that liquidity cycle ever since. And using my forward-looking projections based around this everything code thesis, you know, it should continue all the way into 2025. And crypto should continue to price that. The everything code is a thesis that I put together after 30 years of work where it came randomly. We kind of all know the world's broken. There's all the debt and the demographics and stuff you and I have talked about many times. I started looking at the ISM, the business cycle, so the Institute of Supply Managers Survey, and it was like clockwork every 4 years. And that kind of stopped me in my tracks, like this didn't exist beforehand. And then I realized that what had happened in 2008 was a debt jubilee, where every central bank said, we'll cut rates to zero, so you don't need to pay the interest. Think of it in those terms, because there was too much debt. So every government around the world reset their debt to 3 to 5 year sector. And that lead to this 4-year cycle, which is the same as the presidential cycle, and it's the same as the halving cycle, because Bitcoin was born out of that, right? So everything is now perfectly cyclical. And that won't change until we solve the debt problem. And once you understand that, you can then forward look where liquidity is going to go. Because if we're repeating the same cycle, you just use the old cycle, map it forwards for ISM, and it gives you a forward look on assets. And if that's the case, then it's a real code. Now, what I found within this was that the use of the balance sheet by all of the central banks was just for one thing: to pay the interest on the debt of the previous cycle. So they are just debasing the currency in the purest, simplest form, which is why we all make so much money out of crypto, because it does the best, because it's got technological adoption and it's a scarce asset. So it does phenomenally well when they debase. So liquidity comes in, that's great. Debasing the currency is super great. And so we've now got, coming forwards, if we look forwards, we've now got all the COVID interest payments to make. You cannot do them at 5.5%. We saw that before. The bond market freaked out. There's no way you can finance it without all the debt payments going exponential. So the Fed have to bring rates down, and it's going to end up on the central bank balance sheet, as it always does, because there's no other way. Because if you think about how the world works, is GDP growth, trend GDP growth in the US is 1.75%. The government's 100% of GDP in debt. It's actually more, but easy maths.
Let's break down Raoul Pal insights into easy-to-understand pieces. Liquidity and investment bottoms. Raoul noticed that when the overall availability of money in the market, liquidity, hit its lowest point last year, that's when cryptocurrencies like Ethereum and tech stocks hit their lowest prices too. Basically, when there's less money flowing in the economy, investments tend to be cheaper. The Everything Code. After decades of observing the financial world, Raoul came up with a theory he calls the Everything Code. He noticed that every 4 years, there's a pattern that repeats itself in the economy, linked to how businesses perform, tracked by something called the ISM survey. Political cycles like presidential elections, and even Bitcoin's technology cycles. Debt and central banks. A big part of this cycle involves dealing with debt. In 2008, to avoid a major crisis caused by too much debt, central banks around the world decided to cut interest rates to nearly zero. This made it easier for governments and people to handle their debt without worrying about the extra cost from high interest rates. Raoul sees this event as a reset, which now influences these 4-year economic cycles. Currency debasement and crypto success. Central banks try to manage the economy by controlling interest rates and printing more money, which can make the value of money decrease, a process known as debasement. This situation is actually beneficial for cryptocurrencies like Bitcoin because they're designed to be rare and not controlled by any government. So, when the value of regular money goes down, the value of cryptocurrencies often goes up. The future and interest rates. Looking ahead, Raoul suggests that because of the economic strain caused by the disruption between 2020 and 2022, the Federal Reserve and other central banks might have to lower interest rates again to make it easier to manage government and public debt. This is because the cost of repaying debt, interest payments, becomes unsustainable when interest rates are too high compared to the growth of the economy. In summary, Raoul Pal believes that by understanding these patterns and cycles, particularly how debt and liquidity move through the economy, investors can make more informed decisions about where to put their money, especially in cryptocurrencies, which benefit from these cycles of currency debasement and are seen as a hedge against the traditional financial system's challenges. Okay, let's get back into the video.
It's a 5%, that's 5% of GDP that needs to pay the interest. But growth is only growing at 1.75, so you'd have negative growth. Oh, but the private sector is another 100 and something percent of GDP in debt. So they're competing for the same GDP to pay the interest. So something has to give, and what gives is the government side ends up on the balance sheet. So this was all this big thesis I found from the Everything Code that made everything explainable. Why asset prices rise? Why is it becoming predictable? Why have we got these cycles? And what's really going on, which is the debasement. And debasement, to think about, they're doing it about 15% a year on average. So they could have either raised taxes by 15% to get the payments, which is politically unacceptable in an age like now. So instead, they just flip the coins. and debase the currency. And people don't really notice. They just notice that the rich get richer because they can afford scarce assets and the poor get left behind, which is creating this huge political divide as well. Cost of goods rises faster than your income, so you have less discretionary spending power, right? That's what caused the economic slowdown. That was the shit show that happened in 2021, 2022. Asset inflation is different. Your future self is poorer. What an asset is a way of tying up your capital in something with an expected return. So in a future date, you're hoping to be wealthier. The issue is there. So with this regular inflation, which I don't think is sticky, I think it falls back again. Doesn't mean that prices don't come down. The prices come down, but the rate of inflation comes down. This asset inflation is more pernicious, and it's the thing that people don't understand. You know, if you go and speak to your parents and say, how many times your income would it cost to buy a house when they were in their mid-30s, they would say 3 times, 4 times. You ask a 35-year-old now, how many times your income would buy a house? It's like 10, 12, 14, 15 times, right? So their future selves are poorer because they can't buy that house. I think that is more destructive over the long run. They're both destructive, but this is bad.
Yeah, I completely agree. You also have this new motto phrase, don't this up. What is that? And what is that really, I think, kind of reinforcing to people as we go into 2024 and 2025?
Look, you've been around this for a long time. We've all made the mistakes and everybody makes mistakes. It's very hard dealing with an asset, let's say crypto, that is very volatile, but when it runs, it really runs. And you become overwhelmed by emotion. FOMO, you see your friends bought that 100x dog coin and you're like, I want some of that. You want to look for 100x's as opposed to just own some Bitcoin. And if you want to own some ETH and if a few of the big projects and just buy and hold, but people don't do it. They want to start trading it because they think they can make more money. Also, they custody things wrong. People start thinking, I want the extra 5% yield by sticking into some project of which they know nothing about the security of. And the don't this up is don't let somebody take your tokens. Don't trade and hold quality assets.
Let's unpack Raoul Pal's final section of his speech into an easily digestible summary. Investment advice for the crypto market. Raoul emphasizes the importance of disciplined investing in volatile markets like crypto. He warns against the emotional pitfalls of FOMO, fear of missing out, and the dangers of seeking quick, high returns without understanding the risks involved. His advice is straightforward. Invest in quality assets, hold on to them, and avoid unnecessary trading that can lead to losses. He also stresses the importance of securely managing your investments to prevent theft or loss. The "Don't mess this up" motto. Finally, Raoul shares a motto that encapsulates his investment philosophy. Don't mess this up. This phrase serves as a reminder to investors to avoid common mistakes, such as chasing after the next big thing without due diligence or failing to secure their investments properly. His message is one of caution and mindfulness in the face of temptation and volatility. In essence, Raoul Pal's speech offers a comprehensive overview of the challenges and opportunities within the current economic and investment landscape. He provides a valuable perspective on how to navigate these turbulent times, emphasizing the importance of understanding broader economic patterns, making informed investment choices, and practicing disciplined asset management.